To incorporate or not incorporate? That is the question. People often start off their side businesses as sole proprietorships. This can be helpful from a tax perspective if the early stages result in losses, as these losses can be offset against their other income and provide a tax deduction. As the businesses grow, they often hear about the tax advantage of incorporating. Yes, there are real possible tax benefits. However, there are costs associated with operating a corporation that need to be considered as well. First, though, we need to consider how much money you're making from your business and what are you doing with that money. A corporation pays tax at 11% on its first $500,000 of profit. That's a pretty attractive rate compared to up to 53.5% personal rate. But that rate only applies if you leave the profit in the company. So if you're going to be withdrawing all of the income from the company for personal living expenses, then you will end up paying personal taxes on that income anyway. There goes the tax savings. And yes, you could take dividends instead of wages. However, dividends come out of after-tax profits in the company. So it will pay the 11% first, then you will pay personal tax on the dividend. Generally, the combined amount works out to the same tax bill either way. Even if you're able to leave the income in the company, there are still costs associated with operating through a company. Every corporation must file a tax return together with a full set of financial statements. So you will likely have to pay an accountant to file that return anyway. There are other costs, such as annual report for the province of BC, as well as just the compliance burden of having the corporation separate from you. So while you might save 30% tax on that extra 10 grand income you make, it could cost you that much to keep the company operating. So before you set up that company, talk to an accountant. It will be well worth your time.